Hello, and welcome to the Josh Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories. Hello, and welcome back to the Josh Brown Podcast. I'm Devin Joss.
I'm Dan Joss.
And today we have a topic. It is called Retiring During a Down Market. And so, picture this. You've had a great 40-year career at your company. About to retire. You do retire, you have all your vacations planned for the year and whatnot, and the market drops 20%, 30%, maybe even 40%. That'd be a very scary feeling, and there's a lot of things that you could do, you should not do, so that's kind of what we're going to talk about today. The first thing we want to acknowledge is that we know it's an emotional time, kind of this high of retirement and then this economic low, and you'd probably be feeling a lot of things. Do you have experience with that, or any clients feeling this?
Well, I have experienced two 40% market declines.
Yeah.
2008, the market dropped very quickly in a year, with some decline in 07 and more decline in early 09, but that 08 was a big year. And then also 2000, 2001, and 2002, the market kind of, over those 3 years, declined 40%. And we've had clients retire during those years.
Yeah.
But yes, fear, second guessing, should I
go back to work?
Should I not retire if you're in that?
Yeah.
We have clients right now who are planning to retire in the next 12 months. And so it could be sooner than later, but if we were to see a market decline again, and we saw that last year in April, the market dropped 20%, they have a legitimate question. Should I just keep working? Which is a fear response.
Yeah.
And so we would say, don't change your plans. Continue to retire, because if the average retirement is 30 or 40 years, we will see lots of 20 or 30% market declines.
Yeah.
And going back to work won't stop the market declines.
Yeah.
So we would say, don't let the market volatility impact your life plans.
Yeah. Or don't let your emotions make you act too quickly.
Yeah. It's like, if you have a plan, just do the plan.
So we're going to discuss a little bit of what not to do and then what things to do. But just before that, why do markets, down markets specifically, feel different at retirement?
Because you're not investing anymore.
Yeah.
I mean, you're not adding to your investments anymore. You're not.
Flow.
Yeah, you're not adding to your 401k. You're not adding to your TSP. You're not putting money in. And I would submit, for the last 40 years, when you saw a market decline, you could say, oh, I'm adding and I'm getting more shares. Well, when you're not doing that anymore, you're not benefiting in the same way from a market decline.
Yeah. And I think it's easy.
Secondly, also, the numbers are bigger. You know, 25-year-old is adding $1,000 a month. A 65-year-old, a 20% decline in the market could be several $100,000.
Yeah.
It's not quite the same.
Yeah.
You don't work another week to make it up.
Yeah.
So both of those reasons.
Yeah. And I guess if you're 30 years old and a market drop isn't the worst thing, because you're not going to be touching the money until retirement.
I got 30 years to go.
Keep working. And
I guess that's the third reason. So one, I'm not adding anymore, taking advantage. Two, the numbers are bigger. And three, I'm using the money.
Yeah.
Withdrawing. I need this now.
Yeah.
So and then it feels like you're selling low.
Yeah.
And in reality, because we've done our job right, we're going to take something out of fixed income if something in the portfolio will be up.
Yeah.
Most likely.
Yeah. All right, so what do we not do?
Panic.
Don't panic. It's hard not to panic.
That's
We just talked about all the things of why
That's
we
right.
should panic.
Well, as our job of advisors, we have that phrase is we're talking clients off the ledge.
Yeah.
It's like we're reminding you of the long-termness of the investment. We're reminding you that you have a plan to retire, so continue to live out your plan.
Do you have examples of, like someone actually panic selling?
Yeah, I had a client. There was 3 responses in '08 to the market decline. One was, I get it, sell some fixed income, buy some stock because they're down. Just a regular rebalance.
Yeah.
Second response was, I get it, but I'm not going to buy anymore and I'm not going to sell my bonds. So just let me sit it tight for a while.
Wait it out.
Yeah. And third was, I either want out of the market altogether or I want to reduce my allocation of equity to, and they went to 20%.
Wow.
So we achieved their results of not losing any more, but we also
But when it recovered, they
didn't get the recovery.
Yeah. I guess that's kind of more dangerous than...
Because they changed they let fear, one, they panicked, two, they altered their investment philosophy, their investment policy statement.
And then the question would be, when do they get back in?
Yep. So if something is 100 and it drops to 80, and they say, okay, I'm going to sell now and I need to get back in. Well, what if it immediately goes back up?
Yeah.
Back to 100. Do you get back in at 100?
Yeah.
Or do you wait to 120? See,
yeah.
Or if it's at 80 and you say, I want to get out, then it goes to 60, do you feel more comfortable to get back in at 60? Or do you think it's going to continue to fall further? So all of these questions are thought through in the investment policy statement.
Yep. That's why we have that. It's kind of the accountability partners.
Yeah, the policy doesn't have emotions.
Yeah. It is what it is.
Yeah.
The next thing is, don't delay retirement indefinitely if you're fearful of that. That's why we have plans. That's why we talk about these things every year, twice a year, for the clients near retirement. Don't delay things out of fear. There are things that you might delay, like a car purchase or a huge vacation.
Yeah, discretionary expenses.
Yeah, those discretionary ones. But when it comes to your job, that's kind of a more life question. What else? What not to do?
Don't overspend early. That's a similar, like you said, about discretionary expenses. I remember calling a client in '08 because we had a plan to buy. They had a plan to buy a new car that year, and we said, "Markets are down. Do you want to buy that car? You have the resources." And we had something in the portfolio that was up, so we weren't going to sell anything in a down market. And they said they didn't feel like it. Like, all right, we'll buy it next year.
Yeah.
And in '08 it was fine because it recovered. The second half of '09 was positive, and they felt more comfortable spending some money.
Yeah.
So, but the plan was such that they didn't have to do that, but it made them feel better to delay the purchase.
Yeah.
Problem, because in 2000 or 2001 they delay. Well, it went down again, and it went down again.
And keep delaying.
And so eventually you need to spend. That's why designing the portfolio so that you take those expected expenses into account works.
Yeah.
Otherwise, you'll go to and fro and never live your life. You'd be worried about what happens in the markets. And we're seeing that same thing this year too. Markets are up. Yeah, but it could fall.
Yeah.
But it's up. Spend money.
Yeah.
So.
Yeah, we don't get a lot of phone calls when the markets are up. And the last one, don't make long-lasting decisions based on temporary volatility. So as investors, we have the long-term goal in mind. We invest for the long run, not for short-term. And so that short-term volatility or market drops, we don't want to make a lifelong herding decision based off of that.
Yep.
What kind of decisions would that be? As huge purchases or?
Well, we talked about kind of a car expense. It's like you could delay that. Entering a long-term contract, buying or selling a home, you don't necessarily want to do that based on. You want to do your financial decision based on your life, not based on what's happening in the markets.
Yeah. All right, cool. Well, that's what not to do. It seems like, in summary, what not to do is don't panic, don't make poor decisions,
Charlie
or
Munger,
quick decisions.
Yeah, Charlie Munger had a phrase, I think it was inverting or something, like always invert. Like, find out what you could do that would hurt you and don't do those things. So avoid those mistakes.
Yeah. All right, so moving on to the better strategies, what you should do. So one thing could be is to speak with an advisor if you don't have one. I think the pros to an advisor are just having a second eye on your investments, on your lifestyle. They can give you confidence in certain situations. Even if it's you need someone to confirm what you think you already know.
Yep.
That's what we've seen with our clients during some situations. Like you mentioned being talked off the ledge, and I think you've had examples of clients calling you, asking for them to talk.
Yeah, I know what you're going to say. I just want to hear it again.
Yeah.
Okay, we'll say it again.
Yeah. So yeah, having an advisor is always good. And then just going back to the basics of have an emergency fund. Always have that ready. It's kind of like the do not touch money unless it's for an emergency. And during a down market, and you have an emergency, that's what it's there for.
Yep.
Try not to sell out of stock if you don't have to. So yeah, what else we got?
Delay big purchases.
Yep.
This takes a little bit of analysis, but you do that all day long for people, is maximizing the Social Security benefit in your later years so that it'll be there as a source. The most benefit will be there to meet your needs.
Yeah. I think even if you do make a panic sell, delaying Social Security might be in your interest.
Yeah.
I guess it depends on your cash flow needs. So that's always a question. Another strategy would be to rebalance intentionally. And so when the market does go down,
when it corrects,
yeah, you want to,
or when it consolidates.
Yeah, I guess that's a good word. Rebalance intentionally.
Yeah.
We like to get back to target on that investment policy statement. Yeah, so those are some good things to do. Now, just for a historical perspective, how does our long-lasting history of the market give us confidence for when a down market does occur?
Well, the way we invest is in broad asset classes. And so we don't pick one company to invest in. One company can go out of business. Diversification gives us some stability.
Yeah.
And we can look at market averages. And we know that markets are cyclical, so there will be ups and downs. That's just the way the economy works. 2000 to 2002 decline, we saw that recovery. We saw 5 years of positive markets until 2007 and 8. And 9, we saw down the first quarter and then up the last three quarters of the year. And then we saw positive returns for many years. What was more frustrating, perhaps, was kind of this sideways movement for a number of years. We saw that in 2013, 14, 15, somewhere around there. It kind of went back and forth, but not much movement. Then in 2000, we saw a lot of inflation and the markets go up. 2000, let me see, 2020, I mean, and 22 we saw a decline, and now we've seen 3 positive years. So we'll see ups and downs.
Yeah.
But as long as we buy things, some company is making it, and they'll benefit, and they'll be in business. We'll always have banks. We'll always have cars of some kind. We have clothing. We have houses. And all of those things are what people do. They go to work every day. And the company you work for makes money, and the stock has a positive return. That's called profit. If you don't have a profit, you're not in business. And so that happens too. So just invest with that in mind and retire knowing that chances are, 25% chance that you're going to retire into a down market. And that's okay. We've built those assumptions. We haven't built assumptions of negative returns for your full retirement. If it's 30 years, we've built in some reasonable returns, and it just so happens that first year, wasn't the best year in retirement. My first 3 years of my financial advice career was all negative years. And someone was retiring when I was entering the workforce.
Someone was retiring.
And that's right. Someone is.
Last year,
I think
April.
I've heard commercials about that. How many millions of people are retiring every month? Just like millions of people are being born every month too. So that's just part of life. So realize that cycles happen.
So there's a lot of things to not do. There's a lot of good things to do. Obviously, it's not ideal, the most ideal situation to retire and the market go down, but it's definitely manageable. Keep the long run in mind. Your retirement could last 30 or 40 years, and it's not going to be defined by 1 year. I'm sure there'll be several down years during your retirement. Just keep the long-term mindset and stay disciplined, stick to your plan.
And ask your advisor to show you what that looks like.
And if you don't have an advisor, reach out to us, and we'll gladly be able to provide some help or some advice possibly. That's it for this episode. Feel free to ask more questions or let us know if you have any episode ideas.
Great.
Until next time. Thanks.
Thank you for tuning in to today's episode of the Joss Brown Podcast. If you'd like to see more episodes, visit our website at jossbrown.com.